Procter & Gamble has raised its dividend for 69 consecutive years. Through every recession, every crash, every crisis since the 1950s. 69 years without a single missed increase. And as of this morning, it's inside your SCHD. The 2026 SCHD Reconstitution just made 25 additions and 22 removals. The biggest shakeup in its history. And when I saw some of the names that got kicked out, and the reason why, I realized this fund just got a serious upgrade. I've held SCHD in my portfolio for years now. Every March, I watch the Reconstitution the way some people watch the draft. But this year hit different, because when one stock's numbers came back, a 284% payout ratio. I understood exactly why the system works the way it does. More on that in a minute. Quick disclaimer. I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. So let's break down exactly what happened in the SCHD Reconstitution for 2026. Every March, the Dow Jones U.S. Dividend 100 Index. That's what SCHD tracks. Goes through a full annual reconstitution. Think of it like a quality inspection. The index looks at roughly 2,500 companies, runs them through a brutal 4-part scoring system, and picks the top 100. If your numbers slip below the cutoff, you're out. No loyalty, no exceptions. And this year, 22 stocks didn't make it. That's one of the largest turnovers SCHD has ever seen. Now let me walk you through every stock that was removed from SCHD and every new holding that was added. Because the SCHD 2026 changes tell a much bigger story than most people realize. Let's start with the heavyweights. Cisco was sitting at 3.66% of the fund. A top 15 position, gone. AbbVie at 3.47%, gone. Valero Energy at 2.63%, gone. But it goes deeper than just those three. Here's the full picture of what got removed, grouped by what it means for the fund. First, the energy purge. 6 energy-related stocks were removed. Valero, Halliburton, Ovintiv, CF Industries, LyondellBasell, and Huntsman. That's the biggest sector hit by far. Before this reconstitution, SCHD had roughly 20% of its weight in energy, 1 in every $5. After this, about 12%, an 8 percentage point swing in a single day. The implication? SCHD just dramatically reduced its exposure to oil price swings and commodity cycles. If energy crashes again like it did in 2020, the fund is now far less exposed. Second, the small bank and financial cleanup. 7 smaller financial names got cut. Companies like Unum Group, Janus Henderson, and Radian Group among them. These were all tiny positions, most under 0.5% of the fund. You probably didn't even know they were in there. But the quality filter doesn't have a minimum size exception. If your numbers slip, you're gone, even at 0.25%. Third, the consumer and industrial cuts. Whirlpool, Signet Jewelers, Carter's, Packaging Corp of America, Amcor, and FMC. These are companies in consumer discretionary, materials, and specialty chemicals. Whirlpool is particularly interesting. It's been struggling with housing market weakness. Carter's is a children's clothing company that's seen declining sales. The filter doesn't care about brand recognition, only numbers. And finally, Kforce, a staffing company. The smallest position removed, that's all 22. Now, where did all that weight go? This is the part that got me genuinely excited. Let me walk you through the 25 additions. Again, grouped by what they mean for your portfolio. The healthcare upgrade is probably the most significant. UnitedHealth Group just entered SCHD. This is a $370 billion company, the largest health insurer in America, roughly 15 consecutive years of dividend growth. Then Abbott Laboratories, 13 straight years. These two alone add massive healthcare weight to the fund. Healthcare jumped from about 16% to roughly 20%. That's 4 percentage points of new exposure to a sector that tends to be recession-resistant and demographically driven. People need healthcare regardless of what the economy does. The technology infusion is equally important. Qualcomm, 21 consecutive years of dividend growth. They make the chips inside most smartphones worldwide. Accenture, about 19 years, one of the largest consulting and tech services firms on Earth. ADP, 49. Consecutive years of increases. 1 year away from Dividend King status. And Broadridge Financial, over 16 years. These additions push technology exposure up about 3 percentage points. But here's the key. These aren't speculative tech companies. These are profitable tech companies with long dividend track records. That's a rare combination. Then there's the consumer staples anchor, Procter Gamble with that 69-year streak we talked about. Tide, Gillette, Pampers, Crest. Products people buy in recessions, in booms, in pandemics, no matter what the economy does. Comcast also came in, adding media and telecom diversification. Now here's something really interesting that most people are going to miss. The financials overhaul. Financials surged from roughly 9.7% to about 15%. But look at WHO was added. Blackstone, one of the largest alternative asset managers in the world. Ares Management, another major alternative asset firm. Principal Financial Group, a diversified financial services company. Booz Allen Hamilton, a government consulting giant. Old Republic International, over 40 consecutive years of dividend increases. Erie Indemnity, over 30 years. And then there's a cluster of community and regional banks, about 5 or 6 smaller financial institutions. These are tiny positions individually, but here's what makes them interesting. These little-known banks beat out thousands of larger companies on the quality composite. Their free cash flow, return on equity, and dividend growth metrics are strong enough to earn a spot alongside Procter & Gamble and UnitedHealth. Small doesn't mean weak, it means overlooked. And here's the one that might surprise you most. Devon Energy was added, even while 6 other energy stocks were removed. Why? Because Devon's quality score was strong enough to make the cut. Its free cash flow to debt ratio, its return on equity, its dividend growth. All passed. This proves the Reconstitution isn't anti-energy. It's anti-bad fundamentals. Devon earned its spot. The others didn't. Even Macy's made the cut. Korn Ferry, a talent management firm, Marzetti, a specialty food company, and Penske Automotive Group, one of the largest auto dealership groups in America. 25 additions total. So what does the fund look like now? Let me give you the full picture. The core didn't change. Lockheed Martin is still the top holding at nearly 5%. ConocoPhillips at 4.77%. Chevron at 4.69%. Verizon at 4.52%. Bristol-Myers at 4.23%. Then Altria, Merck, Coca-Cola, PepsiCo, and Texas Instruments round out the top 10, all between 3.8% and 4.2%. These are companies that pass the quality filter. Again, their fundamentals survived another year of scrutiny. But the new additions, especially UNH, PG, Qualcomm, and ADP, could potentially climb into top positions over time as the fund reweights through quarterly rebalancing in June, September, and December. The maximum any single holding can reach is 4.5%. So these blue-chip additions have room to grow within the fund. Here's a practical way to think about what changed. Before this reconstitution, if oil prices crashed, 20% of your SCHD would take a direct hit. Now, only 12%. That's a meaningful reduction in single-sector risk. On the flip side, you now have more exposure to healthcare, a sector driven by demographics and aging populations, and more exposure to profitable technology companies with long dividend histories. For long-term retirement planning, that's arguably a better mix. Now let me explain why these specific stocks were removed, because this is where the quality filter effect becomes crystal clear. SCHD ranks every holding on 4 metrics, each worth 25%. Free cash flow to total debt, return on equity, dividend yield, 5-year dividend growth rate. AbbVie's payout ratio had climbed to 284%. For every dollar earned, $2.84 paid out. nearly 3 times their earnings. How do you sustain that? You borrow, you burn through reserves, and eventually, something breaks. The quality filter caught this before it became a crisis for investors. Cisco got expensive after a big run-up. Its debt ratios shifted. Quality score dropped, done. Valero's yield fell below the fund's average. Its 5-year dividend growth weakened. The free cash flow picture deteriorated. The filter doesn't care about popularity, it cares about math. Now let's talk about what all of this means for your money going forward. The yield stayed at about 3.6%, essentially unchanged, so your income didn't drop. But the quality of that income arguably went up. You're now getting paid by companies with an average consecutive dividend increase streak that's significantly longer than before. SCHD has historically delivered around 10.6% annualized dividend growth over the past decade. With the additions of companies like P&G, ADP, and Old Republic, each with decades of growth history. That growth engine could potentially stay strong or even improve. And here's the broader context. In 2025, SCHD returned about 4.3%, while the S&P 500 returned nearly 18%. People questioned dividend investing, but in 2026, SCHD is up roughly 12 to 15% year-to-date, while the S&P 500 is down about 1%. The tables flipped. Quality dividend payers became the anchor during market turbulence. The trailing P/E sits around 17 times earnings versus the S&P 500 at 29 times, nearly half the valuation. That's a significant margin of safety for your investment portfolio. Let me put some real numbers on this. If Harry had $100,000 sitting in SCHD right now, at a 3.6% yield, that's about $3,600 in annual dividends to start. But with 10.6% historical dividend growth, that starting dividend could potentially grow to almost $10,000 a year by year 10. That's roughly $820 a month in passive income streams. From a single investment, with the dividends growing on autopilot every year. And remember, past performance doesn't guarantee future results, but the quality of companies now inside this fund, P&G with 69 years, ADP with 49, Old Republic with 40 plus. That growth engine has arguably never looked stronger. Now, should you be worried about this much turnover? 22 stocks out, 25 in. Sounds like a lot of disruption. Actually, it's the opposite. This is the fund working exactly as designed. The Reconstitution is the mechanism that keeps SCHD from becoming a stale collection of yesterday's winners. It forces evolution. Cut deteriorating positions, bring in stronger ones. There's also something fascinating about the timing. Last year's Reconstitution in March 2025 doubled energy exposure, from 12% up to 21%. This year, the fund reversed it. Energy back down to 12%. The quality filter has its own self-correcting mechanism. When a sector gets overheated and fundamentals deteriorate, the system trims it automatically. $85 billion in assets are rebalancing right now. That creates real buying pressure on the additions and selling pressure on the removals. If you were thinking about buying any of these removed stocks individually, be aware that SCHD is actively selling its positions in them. That selling pressure could push prices down temporarily. On the flip side, the 25 new additions could see a short-term price bump as $85 billion worth of demand flows in. Now, what should you actually do with this information? A few things to watch. First, the Q1 2026 dividend. Estimates are pointing to somewhere between 25.87 cents and 27.07 cents per share. That would be roughly 4 to 9% higher than the same quarter last year. Despite all this turnover, the dividend growth engine appears intact. Second, watch the removed stocks over the next few weeks. If AbbVie's payout ratio was already at 284%, a dividend cut could be coming. That would validate the quality filter's decision. Same for any energy stocks that lose further momentum. Third, compare SCHD to other dividend ETFs you might hold. VWAM holds over 400 stocks but doesn't screen for free cash flow to debt the same way. DGRO screens for dividend growth but doesn't rank on return on equity with the same weight. SCHD's four-part quality composite is genuinely unique in the dividend ETF space, and this reconstitution is the proof. For my portfolio, I'm not changing anything. The quality filter effect just proved it works. Catching unsustainable payout ratios, trimming overweight sectors, and adding companies with decades of dividend growth. 69 years from Procter Gamble, 49 from ADP, 40 plus from Old Republic, 30 plus from Erie, 21 from Qualcomm. That lineup didn't exist in SCHD yesterday. It does today. The real question isn't whether SCHD changed too much. It's whether you understand what those changes actually mean for your financial independence, and whether you're positioned to benefit from what could potentially be the strongest version of this fund we've ever seen. I'm doing a deep follow-up in a few weeks showing exactly how these new holdings are performing. Real numbers, real results, whether the additions pulled their weight, and whether the removals proved the quality filter right. You won't want to miss that one. If you want to see how SCHD's dividend growth has compounded over the past decade and what it could potentially mean for your retirement income, that breakdown is right here.